the reason why I joined Cadence one, right? Number one, is the cheapest one. Really, it's the cheapest one.
So you must say undervalued.
Undervalued. And then in fact they provide you 4 days of lesson while others the one lesser, and that is more expensive. That's number one.
They cut their lesson into 2 pieces.
I think only 1 piece.
Yeah. One piece, if you add together 2 pieces, the cost is 10,000.
Oh, then the one that I know is only the first piece.
Yeah. The first piece is already more expensive than my full piece.
Yes. So that's the first reason. And the second reason is I wish to get more money lah. It's a very cruel world over in Singapore. So everything is increasing, the price are increasing, and that's why I'm here lah. That's why I joined the class. So what's before and after? Before I did nothing lor. After I did something lah. But then so so right now I graduated on May, and then I started to do some trading starting on July onwards, because on May and then this June I just trying to mingle around and trying to explore, and then July I really started doing something. But then after that, right, I did nothing again until lately only I try to do something again. Okay, so I'll go with this book. Right now, I'm going to present this book is One Out on Wall Street by Peter Lynch, the second part. So if you guys have realized, I presented on August or September, I forgot the part 1. And right now, the part 2. During the part 1, just a very short recaps. I mentioned something like this. For Peter Lynch, right, I stopped at this area, the part 2, for Peter Lynch picking the winner. So for Peter Lynch, when he's picking the winner, right, he has several questions, several conditions. But Peter Lynch is a very... Because my hand, okay, I can.
Okay.
Okay. So for Peter Lynch, right, to me, his theory is quite easy to understand. What he wants to do is something everybody can understand and very simple. He just wants the name of the company sounds dull and even better ridiculous. Is to investor, why does anybody care about the name? But to him, yes, he cares about the name. The simpler, the better. Like a company called Pet Boys. He invested a lot in this company. The second point is it does something dull. If you guys know, he invested in a company called 7 Oak International. Their main business is just to process voucher. That's all, nothing else. Just to process voucher. And that company is a very big hot for him. But then right now it's delisted because it was purchased by another company. And it is a spin-off, which I'll explain why spin-off later again. And then there's something depressing about the company, or it's a no-growth industry. These two, right, I can give an example of a SCI. It's a company that provides funeral services. So funeral services usually is something that very depressing. People won't touch about it, and it's a no-growth industry. Because I believe you won't hear people say, "Oh, 2020 is a funeral boom." No. You will only hear computer boom, IT boom, but not funeral boom. So it's a no-growth industry. And then the next one is it got niche, or what Caden taught us is got moat. And then the insiders are buying, and then the company is buying back shares. So moving on from part 2, right? When picking the winners, there are several stocks that Peter Lynch would like to avoid. So it's Xerox. Okay, I'm just a disclaimer. This Xerox I'm talking right now is a few years back, like 30, 40 years back, but not now. Right now, I'm not so sure. I have never done any research about it. So for this Xerox, right, the reason why the reason why Peter Lynch avoided this stock is because he was the first company that, okay, in 1972, it was $170. And he was the first company that invented this copier. The entire thing, right, is a photocopy machine. It was the first photocopy machine in the world. They invented this. And then this photocopy machine is so big and then it's so bulky, you need to hire one person to operate it. So this girl over here, the full-time job is just printer. They call it this girl printer. So she has to operate the machine in order to work for the photocopy machine. So followed by years ago, Canon, IBM, Kodak, they also did the photocopy machine. And guess what? The next year, the stock starting from 170 dropped to 60. So what Peter Lynch wants to highlight in this case study is that he always avoid hot stock. The reason being is hot stock, it goes up very fast. It also goes down very, very fast. So sometimes, like amateurs like us, right? Perhaps when we buy this stock, right? We don't buy from here, we buy from somewhere here. So when it go down, it come back to here. So in fact, we lost. We don't really earn a lot. So for amateurs like us, try to avoid hot stocks. This is something that he like to avoid. The second thing is diversification, like what Caden say.
People like hot stocks. they really like they like the latest, sexiest Hong Kong.
Oh, okay. You have to get out earlier also. Lah. Okay. So diversification, like Kaden has mentioned in their classes, is something we want to avoid. But for Peter Lynch, right, he see this as an opportunity. So imagine this apparel company is buying this food company. This apparel company, obviously he's doing diversification. But then for Peter Lynch, he sees opportunity like this. It's an arbitrage. So instead of buying this company, you don't. You buy the share of this company. So from here, right, you can earn a bit of money, like if let's say the arbitrage works. But then avoid this kind of company. If you really want to invest in this deal, right, invest in the one being bite, being arbitrage one. Okay. The next one is IPO. No matter how, we have to avoid IPO. But for Peter Lynch, again, he see opportunity. Only purchase IPO when it is a spin-off. So what is a spin-off? For example, earlier, right, York was under a subsidiary of Bob Warner. Because York, right, he's very good. He can perform independently, and then everything is good. Financial statements, everything is cool. Management is steady. So the Bob Warner decided to spin off York International, meaning that they decided to cut off this company as a subsidiary, make it into an independent company. So from this process, it is a spin-off. Usually a spin-off will only occur when this company, the younger company, right, is stable. Nobody will ever do spin-off if let's say the younger company is not stable, because this will bring a bad reputation to the mother company. So if you know there is a spin-off and then you see it has an IPO, you can take a look on it. And if you realize, right, if the mother company is purchasing a lot of stocks of this younger company, yeah, you can invest, because they are the one that know a lot, almost everything about this young company. Okay, so IPO you avoid, but then unless it is a spin-off.
Now, recently, I wouldn't say recently, maybe about a year ago, there is one company, there's a spin-off. Right? Bought some, he didn't buy a lot, he bought some. But the one that bought a lot is another value investor called Seth Klarman. Because you type Seth Klarman, he bought a lot of SYF. So how much, when I say a lot, how much? Is of all his companies, SYF ranked the second highest. Data I can show.
So moving on, when picking a winner, obviously we want to pick a winner that has earnings, earning, and earning. In order to make earnings or get earnings, it's very simple. We just need to have more earnings and more assets. So no matter in what financial report, in what annual report, the company is performing very good or very bad, they should focus on how to increase their earning, because the good one want to do better. The bad one, walao, they have to do good in order to earn money. So in order to spot like what are the things that they trying to do to increase their earning, we can focus on these 5 letters, these 5 categories lah. Reduce cost, explore new market, dispose the losing operation, increase sales, and raise price. So from here, we can know that what are their plan to do all this in order to fulfill these 2 conditions. The next one, this one is a bit long. When picking a winner by Peter Lynch, these are the 9 questions that he will ask. He would like to know about the stock, such as what's the recent growth, the debt, the market, where is the market, the existing business, is it making profit, and then is any insider buying, any dividend, is it a slow, medium, fast, or cyclical company, or what are the plans to reduce debt, and how is the company doing? So these 9 questions later on, I will repeat again. I will show this when doing the case study. And the next one is PE. Everybody here knows what is PE, price per earning ratio. So for Peter Lynch, he has a magic number somehow. In order for him to identify which one is the winner, he says this formula: long-term growth rate plus the dividend yield, if there's any, over PE ratio has to be larger than 2. If let's say it's larger than 2, then he said this stock you should look more into it. If let's say it's lesser, try to avoid it. Just don't look into it. Okay, then the next one. When identifying a stock or picking a winner, other than what is surfacing up, right, we have to look for the hidden asset lah. Some company, they have natural resources like timber, land, oil, or metal. Some, they have patents or their moat. And some, they have shares of separate companies which they have invested. and some even their subsidiary. Their subsidiaries, some can be very, very good. Like GE, right? The SYF, maybe earlier SYF is a very good company. Who knows? This is a great asset, their hidden asset. And then the bottom line, when picking the winner, we only and always compare the pre-tax profit. The keyword here is pre-tax profit margin, pre-tax profit margin within the same industry. Because from here, we can know whether the particular company is doing well comparing to their competitors.
In other words, it could be it could be the operating margin or the gross margin. Okay, maybe in case in case you get lost because of some technical terms. Now when they say pre-tax, okay, let me just use this. When they say pre-tax, give a guess. What does it mean by pre-tax? Pre-tax, yeah, before tax. So in the profit and loss statement, the last final expenses that before deduction is always the tax. Yeah, it's tax. So in other words, if you take whatever revenue that's in front, then finally when it reaches the end, and after they minus the tax, whatever that is left is called net profit. Net profit. So before pre-tax, there are two. One is called a gross margin, and the other one is called operating margin. Yep. So during a training, we talk about gross margin must be larger than how many percent? Yeah, 40%. So if it's less than 40%, what should you do? Yeah, stable uptrend. But of course, another thing you can add on to make the criteria even more stringent is you can compare a company, let's say company's A gross margin with another company's B gross margin. Yep, within the same industry. For example, you can compare Coke, let's say with Pepsi, or you can compare, let's say, Amway with Usana, and then you compare the gross margin. Now, if you compare company's gross margin with gross margin or operating margin, now give a guess. If you compare, now which one would it be better? Is it the higher one that's better or lower one that's better? Higher. So I want you to imagine that if you find a good company that passes through the funnel, is undervalued, and then the margin, whatever margin you talk about, is the best among the industry. Well, then there's nothing much to say. Then it's really the best. Yeah. So just keep in mind, I'm just going to go slow over here. So remember in your VA funnel, yeah, if it's more than 40, it's already very difficult. Yeah. If it's below 40, yes, you're also right. Stable is good, uptrend is better. Another one, if you want to add another criteria, is other than stable uptrend, if it's the best among all the rest, it's already very good. Great. So I'm going to pause it for a short while. Any question here first? Because I want to make sure that you can catch up before we carry on. Otherwise, you may get lost halfway. Yeah. Hey, like, don't need price even. Like, any question? Sure, okay, Okay, I'll let him finish. Then after that, we can come back again. Yeah, sorry.
Okay. You guys should ask question, because he would answer, else I will be the one answering, and my answer is not exactly correct one.
Yeah,
so last time, any question for Caden?
Yeah, I know how a beginner thinks. So
any questions? So if let's say there's no more questions, moving on. So this is an example for company A and B, assuming both of the companies are in the same industry. And okay, from here it's very obvious. Company A, both company and A and B, their sales are $100. Their cost of doing it for company A is only $88, while for company B is $98. So the pre-tax profit, right, you can see is company A is 12%, and company B is only 2%. So from here, which company would you like to choose if let's say you are going to invest? A or B? A, raise up your hand. B, C. Okay, luckily no one raised up. So obviously it's A lah. But then there's a small tweak over here. Imagine there's an improved business. Both company, they have their sales up for 10%. So both are making $110. And imagine that their cost of making it is up for 5% for both company. So this one, as you guys can see, the pre-tax profit margin at the end is 16%. But for this one, it's become 6.5%. Okay. So the next question is, for company A and B, right? Which one made more after the improved business? Which company made more money? Which company made more profits? A or B? B, right? So the lesson over here from Peter Lynch is that, let's say we are going to invest long term, right? We choose for the one company A. If let's say we are going to invest short term, going in and out, we choose company B. Because that's where you can get higher profit margin and you can earn faster, because as you can see, this one is only 1.334 from this 12% becomes 16%, but over here from 2% becomes 6.5% is 3.2 times fold. That's a lot increment. It's 3 times more. But over here it's less than 1.5. So Moving on. The final checklist for picking the winners. He has separated into all these categories, the six groups, and the generally. The general one, right? Okay. The general one, right? As usual, the PE again. For PE ratio, he prefer it to be the lower, the better, meaning that the lower means that the shorter duration for you to get back your investment. And institutional ownership, preferably none, or the lower, the better. Any insider buying? Yes. And then the earning growth? Yes, consistently increasing. Which one? Either consistent or increasing. If let's say they can be both, it's even better. And the next one is balance sheet has to be strong, prefer low debt to equity ratio. And the cash position has to be the higher the better. So the next one for slow grower, this one I'm think is a little bit repeating from the session. Okay. Okay. Oh, later I'll show you. It's from Finviz, you can get the information. The screener.
Guru focus also.
Focus.
Yeah.
Okay. The next one. Slow grower. Dividend yield. Is the company consistently paying dividends? And the next question is the company use a lot of the percentage of the earning to pay the dividends? For a slow grower, right, this one is very important because it shows that the lower the better, right? The reason is being security during hard time. If let's say they use a lot of their earnings to pay for dividend, right? Imagine there's a hard time, there's a down. What are they going to do? How are they going to survive? Are they going to still pay you the dividend? Or are they going to keep their earnings? This is questions. So if let's say you are buying a slow grower, you have to see the percentage they use for the dividend. The lesser, the better. Like.
So at this point of time, gentlemen, you can take a photo of this. Just taking note that this sentence has a term, and the term is called payout ratio. Yeah, payout ratio. Payout ratio. So what do you mean by payout ratio? Now, assuming that if the payout ratio is 50%, let's say, what does it mean? Simply means that for every $100, they pay out. Yeah, 50. Yeah. But remember, when they pay out dividend, they have to take from somewhere. They have to take somewhere. Yeah. So give a guess, where do they? After the revenue minus expenses, you have the savings or the earnings. They have to take money from here. A percentage of this that is being given out is called payout ratio. But remember, high payout ratio, that means what? That means a lot of earnings is being given out. Low payout ratio, that means a smaller portion of their earnings. Pros and cons. Now, usually when a company has high payout ratio, that means the company usually is quite big. They do not know what to do with the money. There's a disadvantage. Disadvantage is if they pay out all, then something bad happen, then what happen? They got no savings to deal with. So remember.
Kevin, can I clarify? You're going to put this slide in the Facebook later, right?
No, this one is already in the YouTube video. Once you go back, there's more work, right? You go back, find whatever. But now you take photo, there's no work. Yeah. Okay. Yeah.
So moving on, the next category, the medium grower. For diversification, no. Avoid diversification. No matter what category the company belongs to, no diversification. The next one is a long-term growth. It has to be consistently increasing. And the performance during the previous downtime. You have to see whether how did they perform during the previous downtime. If let's say they are not doing so well, right, try to avoid the company. But if they survive and then rebounds back, okay, you can invest in this medium grow company. Sorry. Okay, then the next one, the fast grower. For fast grower, usually it's a smaller company. So usually they have a product that's, how do I say, it affects the company's sales a lot. So we have to identify what is the product that plays huge part of the earnings. From here, we see what is the product and try to analyze the product itself, see how's the market and the customers and the sales. Other than that, the growth rate of the fast grower, right, has to be more than 20%, like what Caden has taught us. But for Peter Lynch, he said between 20 to 30%. More than 50% is a little bit too aggressive, so try to avoid it. Try not to buy it. And then the expansion plan for a fast grower has to be yes, because they are a smaller company, they have to expand. No matter how, they have to expand. And then room for growth have to be a room for them to grow. If not, try to avoid the fast grower because eventually they will slow down and maybe their stock will come down. And the turnaround company, their business is coming back and getting better. And debt structure, how long can it survive without going bankrupt? And of course, there's a plan for turnaround. So usually for turnaround company, right, we have to see what is their plan to turn around. Either they are doing what I mentioned earlier, the 5 things to increase the earnings and assets. If not, just avoid the company because there's no structure or concrete plan for them to increase their earning or asset. And the next one, asset play. For asset play, their hidden asset or their modes or their mode like what I shared just now is high value and their debt is lower the better. Debt. No company wants a big debt. So the lower the better. So moving on to the part 3, the long-term view of the book. So for Peter Lynch, this is how he designed a portfolio. He asked the questions, how many stock is too many? For Peter Lynch, he said, own as many as possible. Because during his time, when he was a fund manager, he owns 1,400 stocks. For him, his theory is like this. We have to own many stocks so that we can have more stocks, have more opportunity for the 10 baggers. For Peter Lynch, 1 bagger means the stock double 1 time. So 10 baggers mean it go up 10 times. So more opportunities, you need more stocks. So from here, you can have more opportunity for 10 times your stock value for 10 bagger. And then other than that, when we are owning a stock, right, it has to be within our circle of competence. And it's a stock that pass all the prospects that I mentioned just now. And we don't diversify into unknown companies or unknown or the categories that you are not comfortable in. And of course, it is unsafe to own only one stock. This is according to Peter Lynch. So we have to diversify our profile, but within our circle of competence and passes all the prospects that I mentioned just now. Okay. And the next one, for Peter Lynch, right, this is his portfolio. 10 to 20% into the medium grower, 10 to 20% into cyclical, and the rest in turnover. For Peter Lynch, he's different. He's a full-time investor, full-time fund manager. So that's why he has more time to monitor. But for people like us, right, we have full-time jobs. So I would say try to avoid the turnover. And maybe these two still okay. Not so bad.
But by the way, as much as you can, you avoid the turnovers and the cyclical. For part-time investors. Now we must understand that Peter Lynch context is a full-time fund. So during the class, remember we talked about the 3 types of company. Which are the 3 types? The fast, medium, and it's already very good. If you can find a few fast, already quite good. Avoid the cyclical and we are not him.
So moving on, what is the best time to buy and to sell for this part? But right here, what is the best time to buy? It's October, November, and December. Okay, the reason being is he has his reason, He said it's year end, so people are trying to sell off their stock to clear their tax, or even try to get the money for their holidays to buy presents for their kids because it's Christmas and New Year. So they need money. So sometimes the people will tend to withdraw to sell their stocks and get the money. So from here, usually I'm not so sure how, the stock market is a good time for us to buy. And the second thing is during collapse, during drops, during burps, during hiccups, during free fall. Oh, all this time, right? This one, okay we can catch up, which is right now but this one a little bit difficult because in order to buy during this period our mentality has to be super strong. Everything is going down, going down, going down. Oh, you want to put money there? What if it's going down? So yeah, but for Peter Lynch, these are the 2 periods that is suitable to buy the stock. And when to sell.
By the way, the months one, take it with a pinch of salt.
Yeah, a pinch of salt. I'm not so sure.
Yeah, there's not much scientific evidence.
Correct. Yeah. So when to sell, right? Okay, there are 2 situations over here. Situation A and B. Are we supposed to sell the winner and hold on to the loser, or sell the loser and hold on to the winner? Make a guess. Who choose this one? Raise your hand. Okay, so 3% will sell the winner, and who will choose the second one? Okay, slightly more, and the rest do nothing. So the rest you just do nothing lah. Let it be, let it die, or let it earn lah. Don't care.
But the reality is most people sell the winners
That's
and,
the
and
rest.
hold on to the losers. Yeah.
Okay.
Yeah. Why? Because they want to realize the profit, ma. So they sell away the winners. So after they realize the profit, they take very happy, right? Then they got the loser, right? Then for the loser, why do they hold on? Because they hope that something will happen, but the hope never come, lah. That's usually the case. That's the reality, correct? Yeah, correct. Most people they sell the winners.
Okay.
Yeah.
So for Peter Lynch, right? No, that's not the case. We don't sell like this. We don't sell simply because it is a winner or it is a loser. We sell according to certain strategies and according to certain criteria. The first one, we sell when the company is not doing what is expected. So it's not doing what we know about the company. And then the second one is very, very obvious external economic condition, such as if let's say you're investing in an oil and gas company, when the oil price drops, eventually the share will drop. So perhaps that's the best time to sell the stocks. But that's just a sample of the very, very obvious external economic condition.
Yeah. One example will be IBM. IBM belongs to the left side. The company is not doing what is expected. Yeah. The other time when Warren Buffett bought IBM, he buy based on a few things. That I think he buy based on one key thing is the management is very good. I can't remember what's the lady CEO. Yeah. So the lady CEO I think has been with IBM for many years and for maybe decades. Yep. IBM has been meeting the EPS target. But I think subsequently for the past, I think 16 or 20 quarters, the IBM didn't meet the expectation. And because it didn't meet, people start selling. And when people start selling, what happened to the share price? Yeah, drops. So IBM is not meeting what people expect. And because of that, people start selling, the share price start falling. And recently dropped quite a lot. No? Recently, I think it drops from, the share price was peaked at 185. And then recently, I think maybe around about 120, dropped $60. So if you bought 180, you have you're holding on to 30% paper loss. So it affect you emotionally. Yeah. So it's true. If the fella didn't meet, maybe you have to consider, even if you lose a bit. It's better to lose a bit than to lose a lot. Yeah. This is a very good point. Yeah.
Okay.
Yeah.
So according to categories again, for a slow grower like perhaps IBM, the fundamental has deteriorated. Okay, deteriorated, and then the competition, right? They are lost to the competition for consecutively 2 years.
Yeah.
So this is what we have to take note, lah. So usually sometimes we invested in a slow grower, perhaps we will just let it go. We think that it will perform well because it's a stable company. But no, don't judge that. Don't think that it will go like this. We have to keep on looking at the annual reports, look at the market again. If let's say they're not doing so well among their competitors, try to sell it off. And then the development, is the slow grower doing any development? If let's say there's none, sell it off because the company eventually cannot go up anymore. It has to go down. Other than that, the acquisition, yeah, they can never do diversification. Like if they does, so just don't buy it, sell it away. The next thing for medium grower, the PE and PE right is higher than their competitors. So later on, I think one of the slides I can show you how to compare the PE among the competitors. Is very simple by using Finviz. And the next thing is the growth. The growth is slowing down. So for a medium grower, if let's say the growth is slowing down, perhaps you have to reclassify them into the slow grower. But you have to check whether their fundamental is as strong as a slow grower, or it's just the growth is growing. The growth is going down. And the next thing is the insiders purchase. None in last year. This one, he just highlighted it, but I'm not so sure how true it is. And the next one is the new product. There's the new product in the medium grower is not performing well. So usually in the annual report, you can see that how much this product contributes to their sales. Let's say it's not doing so well, perhaps you can consider to sell it off. And then the fast grower. So fast grower, their PE is really high, then you have to consider to sell it away or you don't buy it at all. And the next thing is the business. You see their stores are closing down or their inventories are stocking up. So this shows that their sales is going down as well, meaning that they can't cope up with their earliest growth. And the next thing is, this one is a bit weird, but I'll still put it here. The management, right? There are 2 top executives left to another firm. Okay, just a pinch of salt. And next thing, a cyclical. The cycle is end of cycle. For this, I think it's a little bit difficult to judge.
Yeah,
but then the second point, you can judge it. The inventories are building up, which means the sales is going down. And when the sales is going down, right, meaning that what they have done earlier, they thought it will go on and on, but then their inventories is going up, meaning that their sales is going down. So from here, you can roughly estimate that the cycle is going to turn around. And the next thing is the competition is increasing. The next thing for turnaround company, the company that is supposed to turn around, right? They return to their old self, meaning that they can't make it lah. And next thing is their sales is increasing. If let's say their sales is increasing, you have to reclassify them into another company. Oh, sorry, I made a mistake. If let's say they are returning to old self, meaning that they might be returned to the three categories that Kaden has mentioned, the slow, fast, and medium grower. Perhaps they are doing better. Right now, you can reclassify them into these three categories. If not, if they can't turn around, right, meaning that they are going to bankrupt, so you still don't buy. And next thing is their debts are declining, and the shareholders are not embarrassed to own it again. I'm not so sure how to verify this, how to justify this also. And for asset play, you have to sell the asset play, the stocks that you have when their asset, right, is so cheaper than expected, and their shares are more shares are issued, and then their acquisition, they did diversification, and then their institutional ownership is increasing. But what I think is institutional ownership increasing, it doesn't mean that the stock is bad lah, the share is bad. You can still hold on to it. Just that when they do this one, right, the first one, then you might have to check on the company again. Why is the reason they are selling it so cheap instead of the original value? So at the end of the book, it has some silliest and most dangerous things that people say, and Peter Lynch has recorded it down. It says like this: the first one, if it is gone this high already, how can it possibly go higher? But for Peter Lynch, he answered like this: because the fundamental is still strong and cheap. Yes, it can still go higher. So when you see a stock has go up already, don't sell it immediately. If the fundamental is still strong, just keep it. Perhaps your earning can grow again. The next thing, eventually they always come back. So like what Kaden said, those losses one, right, it go down already. So you think it will come back again lah. What Peter Lynch say? They don't. Sometimes they don't. They will just go down again. So if let's say you think that the fundamental is deteriorated and the share price is going down, don't think that it will come back lah. Don't just hope for it. Don't pray for it. Just try to take your action. Perhaps sell it.
Now, okay. Now, before you carry on, there's one part maybe quite vague. When you say fundamentals, can you just define to me what's fundamentals? When I say the fundamental is good, what does it mean? Okay, let's go back to what we learned. Because it may be very generic. We say fundamental. What is it? Yeah. Now, remember in our 4 training, we talk about the SEGA, right? So I want to be very specific here. Now, SEGA, what does S stands for? Search. These are 4 ways. Now, when they say fundamental is good, SEGA, which one does it belong to? The E part. Now, the E part, first one is called circle of competence, which is a qualitative. And then second one, economic mode, which is also qualitative. Now, one example when I say fundamental is, let's say getting worse, is the company may have lost its mode. Maybe it lost certain license to operate. Maybe the secret formula is being leaked out. Maybe there's a competitor. Maybe it has no more at all. Yep. So that one is qualitative. But the easiest way to detect the company's fundamental is deteriorating is to look at the other quantitative criteria. Now, first one, EPS. EPS, if it's deteriorating, what will happen to the EPS? Up or down? Down. Up. Yes, down. Gross margin up or down? Down. Operating cash flow up or down? Down. ROE, ROA up or down? Down. Then the debt up. Yep. So if all these things are the good one become down and then the bad one become up, wow, that one no need to say. Yep. This is what is slowly happening to. Last time there was one bad stock. Remember I told you one ESI stock that I bought. Yeah. They eventually went bankrupt. So this is one example. Then eventually their license was being suspended by the government. Oh, this one died. And then IBM, if you look at the EPS has been declining. So they are not doing that fantastic. So when you say fundamental, remember we go back to the E and then the quantitative criteria. Okay. Good one go down, bad one go up. Habis already. Okay, good. Sorry.
Yeah. So the next one. When it rebounds to $10, I will sell. Perhaps for some of us, we think that the price is getting close, very good already. So I say, okay, when it hit this price, I will sell. So for Peter Lynch, right, he says that unless we are very confident about this company, if not, sell it immediately and make profit. Because the reason why we want to sell this stock, right, is because like what Kaden says, their fundamental or their quantitative one has some problem already. So we think that we should sell it. But then some people, we are greedy. Right now it's 9.99 already. Okay, like wait under 10 lah. So don't do it. You can even sell it at 9.99 lah. So just keep the profit and then ciao lah. Okay. And the next thing is, it is taking too long for anything to ever happen. But for Peter Lynch, right, something will happen after you sell the stock. And then the next thing is check the fundamental. if it is still promising, you should wait. And just to let you guys know, Peter Lynch usually make money after the third or the fourth year. So like what Kaden has mentioned really early just now, for all this to happen, right, for us to earn some earnings, right, we have to wait. We have to be patient, and what we need is time. So we let it go and let it roll.
Yeah. Average holding period for Peter Lynch fast growth stock is about 4 years. Yeah, Walter Schloss for cheap stock, he hold it for average about 2 years. Yeah, don't expect today buy tomorrow suddenly. If it shoot out, then you're lucky lah. Yeah, usually the average holding period is 4 years. Yeah, so Usana went up by 300%. It takes about 5 years. Yep. So the difficult thing is in the doing nothing. Doing nothing is very difficult. Yeah, doing nothing, because every day the share price move up and down, and then you're being told to do nothing. It's very difficult, no? Because you always want to do something. Yeah, doing nothing is very difficult. Yeah, but that's the reason why you join the course. You join the course is to do nothing, and then suddenly you find it very difficult to do nothing. Yeah. Okay. Sorry, time is quite limited. You may have to speed up.
Okay,
15
alright.
minutes. Yeah.
So the next thing is the stock has gone up, so I must be right. Or the stock has gone down, so I must be wrong. So no, it doesn't go like this. So your stock go up, meaning that you may be right. So for what Peter Lynch is, you have to check again and make sure that you are making the profit and take and sell it off at the right time. And if the stock has gone down, no, you're not wrong. Some stocks, some good stock, their price right can drop until very low during the hiccups, during the dive or everything. But then eventually, if it is a good company, the stock price will come back up again. And the next thing, the case study.
Okay. Good.
So for this case study, I'm going to share about one company. It's called Southwest. Anybody heard of it before?
Yeah.
Southwest? Yeah, Southwest.
Yeah.
So
Came out the screener, right? Southwest Airlines.
yes, it's a screen from the screener. So the first condition of Peter Lynch is like what I said in my first slide. The name sounds down. Okay, like Southwest, not very fancy name, just the South and the West. Okay, Southwest is actually an airline. It's a Southwest airline in United States. It's a low-cost air transportation in the United States and a few international markets lah. And then Southwest Airline is the largest domestic air carrier in United States. A little bit more about Southwest Airline. What is so special about this airline that I'm going to share to you today is that Southwest Airline, unlike other airline company, right? Southwest Airline, they have their business like this, point-to-point service. So what is point-to-point service? This is their route. You see their route a lot. Their route lah, okay? And if you check to their competitors, they are doing hub and spoke service, and this is their route. You can see very, very clearly that all the routes are going to this place and then they go out again. But then for Southwest, he's doing like this, here to here, here to here, here to here. It's quite difficult for me to identify the hubs, whether it's here or here or here or here. So this is what's so special about this airline. Because of this kind of business structure, their cost structure also being affected. The first thing is, they usually serve those secondary or downtown airports whereby it's less congested, and then they can reduce the number of aircraft and gate facilities, meaning that the time for them to be at the airport has reduced because lesser traffic, so they can just fly off. And then their second cost structure, right, their business also, they only operate single aircraft type, which is the Boeing 737. So for this, right, they earn their benefit, which is simplified scheduling, maintenance, flight operation, and training. Because if let's say the air stewards, right, would try to operate another kind of aircraft, they will have to go through another kind of training again. But then for Southwest, they just make sure all the aircraft is the same, so that the training just have to provide one time and then it serves all the aircraft. And next thing is fuel efficiency. For Southwest Airlines, they are using this flight, Boeing 737 MAX 8. If you guys have known, this is also the plane that Lion Air has accident with. Okay, this is by far the most fuel efficient air flight that Boeing has, and Southwest Airline is using it. And then the second thing is for Southwest Airline, if let's say their flight right is already old, meaning that the fuel efficiency is lesser, is going down, they will just retire it. For last year, they have retired 61 Boeing 737-300, the classic one. And next thing, a little bit about airline industry. Wow, it's super difficult to do. Everything is intensive. Energy, labor, capital, technology, and then highly regulated, highly taxed, and extremely competitive. So from this point, I hope that you guys can classify this company later in its VIA funnel into the super unpredictable one, which is number 12. Okay. And then, where does this Southwest Airlines flies to? United States and some nearby countries. Next thing is their future plans. Okay, they are expanding to 9 new international locations this year. And then they even have orders to Boeing, right? Firm deliveries up until 2027, not 2024. So these are their order list from Boeing. So at the end of 2027, right, they would have additional 412 airplanes. This is their future plan because they're expanding. That's why they need more airplanes. So going back to the Peter Lynch, that book, right? These are the 9 questions that we have to make sure when we are buying a stocks or picking a winner. The first thing, what's their recent growth in their earning? You can see it's going up, and that's likely until 2017 it goes down. The reason why there's a slide down over here is because they have to increase their wages for all their crews and all their employees due to a regulation that just started on 2016. So after that, they has to pay more to their employee. That's why their earning has slide down a little bit. So for me, I think it's quite okay because it affects all other airlines as well. So I give this a tick lah. Hopefully this one fulfill the criteria. What is the growth in the earning? And next thing is what is the debt situation? Oh, the debt. Oh, very jialat. 2013 to 2017, the debt keep on increasing. So I don't give this one a tick. I just leave it. And where's the market? Like I said just now, all the around 100 locations in United States, and then there are neighboring countries. And next one is, are the existing business making profit? Yeah, they are making profit, quite a good one. I'll give a tick. And next one, are insiders buying? Like the lady just now you were asking. So in order to get this right, this is what the insider owns, only 0.1%. And the insider transition during the past 6 months, right, is 1.99%. They sell off the stock. But you see, institutional own is 80.1%. So I don't think this one deserves a tick lah. For Peter Lynch, he wants the insider to own as much as possible and the institutional owns to be as low as possible. But just out of curiosity, I was thinking, who is the one that owns so much? So I go check. It's Berkshire Hathaway. So apparently Warren Buffett also owned a little bit about this on this company. And then, is there any dividends? And yes, the dividend yield is 0.82% per year. I just take this number is the average of the high and low. So it comes up with this number. And then so I'll give this a tick. So they pay dividend. And then how much is the company making? So the net income from the year 2013 to 2017 is increasing, which is a very good one. So I'll give this a tick also. And then number 8, what are the plans to reduce debt? So apparently I can't find any plans for them to reduce debt other than expand into a new market so that they can have higher earnings. This is the debts that they're going to have in a few years' time. Because of purchase, right? At the end of 2012, they're expected to have 16 billion of debts. I mean, 16 billion more of debts. So I don't think this one deserves a tick. I just leave it here. And next thing is it a slow, medium, fast growth or cyclical? So to get this easier, I use a Cadence VIA funnel, the calculator. I can see that this one is definitely a fast growth company. It has a 42.432% growth comparing to for the past 9 years.
So you use 2008 data. 0.24 is 2008.
Yes.
Okay.
2008. Until today is 5.79.
Okay.
It's a very fast growth company. So, but then it's still less than 50%. So for Peter Lynch, advice is we still can look into this company. The next thing, I'm not so sure whether this is cyclical, but when I switch on Finvista, I see, wow, up, down, up, down, up, down, up, down, up, down. So I think this one belongs to cyclical also. Okay?
The cyclical is actually the EPS.
EPS, not the share price.
Not the share price.
Oh, then this one not cyclical. Very good. Okay.
So if the EPS go like that, right? It's cyclical.
So this one is not cyclical. So take up.
So in our share price cyclical, but not EPS. So we're looking, remember, cyclical company is the EPS like that. And because cyclical, why do we want to avoid? Because we do not know what's the beginning point and the end point to plot the intrinsic value. That's why we want to skip, because you don't know the beginning and end. Yeah. So remember EPS like that, no? You see already quickly zao. Yeah, quickly zao.
So but you see the share price like this, you don't zao. You still can stay here.
Yeah.
Okay. Especially when the price right now is over here.
Oh, this is the latest share price.
Yeah, latest share price. So I think getting out of the facts, right? Out of these 9 questions, there are 5 ticks. And then moving on to the next criteria that Peter Lynch has for this kind of stocks. So generally, the PE ratio, right, they prefer low. So the PE ratio for this company is 13.35. I would say it's quite low. And then the next thing, institutional ownership. The lower the better. No, it has a lot, 80%. Insider buying, no, they are selling. And then earning growth, yeah, it's very good. And then balance sheet, I'll show you later on the debt to equity ratio, and the cash position also I'll show you later. And for fast grower company, they have additional condition, which are the products. So the one products that this Southwest Airline do is they are the regional airline. They bring passengers across United States and some neighbor country. So this is what generates their main income. And the second thing is their growth rate is more than 20, less than 50. Yes. And then the expansion plan. Yes. They plan to expand into 9 new markets this year. And there's room for growth. Definitely yes, because there are still so many places for them to go. The next thing, the PE ratio. Peter Lynch, he has the magic number, the magic formula just now. I'm going to apply it now. So the long-term growth plus the dividend yield over the PE ratio, guess how much it is? It's 3.23. So I guess this company fulfills the criteria. And the next thing is profit before tax. We only and always compare the pre-tax profit margin within the same industry. By using Wikipedia, I search these are the six competitors are low-cost airline in United States. And this under Finviz, right, I put another category under service and then regional airline. It comes up also 6, but then this 6 doesn't match one. So I try to cross out these 3, right? They are not. I'm not so sure why. This one, Sun Country, is a listed company, but not in NYSE, in the New York stock market. And then among these 3, they are not really budget airline. They are the full service airline. So I just cross it off. So as you guys can see, among these 4, the first, second, third, fourth, and fifth, right? You can see that their profit margin is over here, and LUV, Southwest Airline, their profit margin is the highest among the rest. Even comparing to those being crossed out, right, they are still highest. And then the second thing, the PE ratio. The PE ratio is the lowest among the others, except this one. The Hawaiian Holdings Inc. is a full service airline, so we can't really compare it. The next thing, the VIA funnel. This is the EPS. Their growth margin is going down, but then coming up again. I try to check on why is it like this. So I try to go and see other company over here. Apparently, all their gross margin is like this. The shape is almost similar to this. So it's the industry problem. It's not only Southwest Airline one company problem. It's the whole industry. And the second thing is the operating cash flow is going up. Free cash flow is going up as well. And the return on asset is going up and it's more than 7%. And the return of equity is going up and it's more than 15%. And the debt per equity is going down. Despite the debt is going up, but then the equity from year 2013 to 2017 is going up as well. So it kind of like tally off, and at the end, the debt to equity ratio is going down, which is a good sign, and it's less than 0.5. So at the end of the day, I plug in everything with the condition that this is a super unpredictable number 12. And then the margin, safety margin is 30%. At the end, I get $58.73. So what's the price today? 52. Yeah, very fast. Yeah, the price today is 52. So buy or don't buy, I don't know. You guys decide. Okay. So that's all basically. Thank you.
Okay, can we give him a round of applause? Thank you. Now, just to let you know that in the beginning, he shared a lot of theory. So I was expecting him to plug in some numbers and then apply. So eventually, I was a bit impatient. Then at the end, do you realize that he put the theory and then put at the back? Do you realize? He take whatever that's being summarized from the book, right? Then he put it in. And then he put, pre-tax, whatever he add in. After adding in, then he put in what we have learned during the training. So there's one portion where he learned from the book, he applied this Southwest Airline. And there was a portion that he learned from the training and then he applied somewhere. So it was, to me, it was quite organized. Organized, very neat. Yeah, not much technical thing. Then you go one by one. It was really nice. Okay, maybe I spend 1-2 minutes. I think it's a good case study. Anybody want to ask anything? Now it's a good chance. Well, somebody just do this for you for free.
Dividend that declared is much lesser. Which dividend? You mean the dividend they pay to us?
No, he's asking why the equity goes up.
Equity. From what I understand from the annual report, because of the sales is going up, the earnings is going up. That's why the equity is going up. Yes. Correct. Should be they reinvest, because I don't think, because they spend a lot of money in purchasing new flights and expanding new locations. That's why I think it's expanding. But I'm not so sure. I need to check on this one.
Well, but the equity, that one has many components. This one you really have to go into detail why the equity go up. But in very blunt and general, equity is equals to book value. So a good company, there's one quantitative measure that you see a good company is the equity and the book value, which is the same thing, right? You want them to go up as time passes. Okay, so maybe let's do a quick revision. So equity, equity comes from 3 financial statements. Which financial statements are we looking at? The balance sheet. Remember, I always repeat, right? So balance sheet has 3 components. What are the 3 components? What minus what equals to what? Assets minus what? Liabilities equals to equity. So in other words, in order for the equity to go up, there are a few possibilities. One is the assets goes up, and the other one is the liabilities what? Yeah, go down. Or overall net the assets going up faster than the way liability go up. Yeah. So which is why when equity go up, is a good sign, because it simply means that the growth of the assets is faster than the growth of the liability. Yeah. Yeah. So it generally usually is a good sign. Okay. Any other things you want to ask?
Any other question for Caden?
Yeah. It's quite good. Not very simple, quite clear.
Yes.
Yeah. Quickly. Maybe one last one. Yeah.
Turn around. How long to wait? You say turn around company. Are you
Don't avoid avoid. I have no idea when. Some never. I can tell you 99.9% never turn. So you wait, and after that die. Yeah. Don't do it. Don't do it. Now, I can't remember which year's annual report. Warren Buffett has really warned people do not invest in turnaround. Now, I just want you to imagine that Warren Buffett, who is the best investors of all time, said that he don't want to invest. Then people who has no idea go and invest. You're suicidal, you know. Even the best already say I also don't want to invest. Then you still want to outshine Warren Buffett. So don't do it. Don't do it.
Mhm.
Don't do it. Don't do it. Now it's not worth it. Eventually, most of them will die. Yeah, don't. That's not worth it. Don't do it. Yeah.
I have one last point to add. This stock, right, it actually has options. So I just checked on last Friday, right? The options, if you are selling on if you are selling options at 51.5 US dollar, the
Premium.
the premium is 110 US dollar. So
How many percent?
indirectly, it's around 2%. 2%. It's quite okay lah. But I don't recommend you to buy or sell.
Yeah. Later 10:30 we can see. Okay. Okay. That's it. Ladies and gentlemen, can we give Chun Ping a huge round of applause? Wow, very good. Very detailed. Now I just want to answer some administrative question. The first question is very clear, very precise, which is very good. So those people at home, you tan dio. Now, the thing is, if let's say tonight you go back home, or sometimes you're at home, you're not here. You're not here. So where do you get the info? Now, for those people who have finished the 4 days course, remember I asked you to add yourself to group, right? Then during the class I approve. Now what's going to happen is during the class I will post something like this. Can you see? So before the gathering start, I always post a YouTube link. Now remember, I will deactivate the link in about 2 weeks time. So from now only 2 weeks, you got no excuse. Yeah, you can always click. And when you click, right, you will see the screen capture of my PC. So in other words, when the slide transition, you see the transition. Then you hear Chin Ping's voice. But of course, you do not see our face and then hear. Otherwise, I'm very busy. I got multi-camera. Yeah, so only screen capture this. And in the whole Asia, we're the only one that does this. Yeah. So for example, maybe I just click here. So let's say I click here. Can you see? Then you can go and play. And then here it's live. It's live because I've not shut down the video yet. Yep. Okay. Now, if you want, let's say you go back home. If let's say you worry that 2 weeks later it's going to shut down, you can always go and download some YouTube downloader where you can put the URL and then eventually you can download the entire video into your computer hard disk. But I will not do it for you because this one require a lot of work. This one you at home you go and do it yourself. Okay, good. Good. Now, there's one more thing before I carry on to ask who's the next speaker? Xiao Yu. Yeah. Now, I just want to share one thing is one feedback given by Ryas. Now, Ryas was saying that sometimes a new participant, when they finish training, they see, then they go and buy a stock. Yeah, buy a stock. And then he gave example of some people who buy the Hong Kong land. Yeah. Hong Kong land recently, during our most recent class, Hong Kong land, the price to book ratio was 0.37, something like that. 0.37, what does it mean? It simply means that for their asset that's worth $1, 0.37, that means if you buy the stock, you're paying how much? You're paying 0.37. So you're paying 37 cents for something that's worth $1. Yep. So remember, price to book is one example where you evaluate whether a company is cheap or not cheap. So as long as less than 1 is considered cheap. But remember, if you buy the share price today, the share price may go up or go down. go down. Now, this is just a reminder from one of our, not Rias, it's actually Rafe. Sorry, I say wrongly. Now, so let's say this is not the intrinsic value, this is price to book. Price to book. So let's say price to book is, you buy the stock at 0.37, right? 37. Now, price to book. So let's say you buy here. Now, if you buy the stock here, the share price may what? May drop. So it's natural in your entire lifetime, you have never bought the stock before. It's natural that when this share price fall, you don't feel very good. Yeah, you don't feel very good. And then if let's say you buy some more and then the share price drop another time, you feel quite bad. Yeah. Now, in order for you to feel good and confident that the share price drop is a good sign, now it's not easy for a first-time investor, which requires reminder. Yep. So it's a reminder for myself and it's also a reminder for you. Now, there are a few things I just want to remind you, also remind myself. Now, I just want to let you know, now the price can drop. The price can drop, but not the intrinsic value. Okay? But not the intrinsic value. So this reminder for all of us, including myself, but not intrinsic value. Now, what we are worried is what? Is the share price drop, and then what also drop? The intrinsic value. Yeah. So usually the case, the bad case is the intrinsic value. Now, when the intrinsic value falls, most of the time, the share price will what? Will fall. Will fall. Now, the most ideal situation. What's the most ideal situation? What do you think is the best situation? The best situation is what? The intrinsic value what? Goes up, and then the share price what? Fall. Yeah, this is the most ideal. Of course, there's something in between. Now, why? Because if the intrinsic value go up, the share price fall down. What does it mean? Yeah, more discount. Because this one, right? The money they make enlarges, right? But in order for you to look at it this way, and not this way. Okay, point number 2 is we must understand. Now, do not compare share price with share price. This is very important. Do not compare share price with share price. Now, if you do not compare share price with share price, what should you compare with? Number 3 is you always compare share price with what? Yeah, you always compare share price with intrinsic value. Intrinsic value. And in order for you not to do number 2, so that you do number 3, now it requires confidence. And where does the confidence come from? Since you need to compare share price with intrinsic value, that means your confidence comes from what? Comes from your own knowledge in calculating the company's what? Intrinsic value. So sometimes when the share price drop, you panic. Then how do you assure yourself that you're right and the rest of the world is wrong? Is you must go back and then relook at the company and then do some calculation again. If you do the calculation, you realize that, the company is doing well, record-breaking revenue, record-breaking earnings, intrinsic value go up, and then you're wondering how come the company has record-breaking earnings, quarterly report or whatever, and then the share price keep dropping. That means you're very heng, That means you're finding something that the company become more and more valuable, and then they're selling you cheaper and cheaper. Yep. So let me do it one more time. Now the price can drop, but not the what? Intrinsic value. Yeah, it's a reminder for myself as well. So the second point is do not compare share price to share price. Because if you compare share price to share price, what will you do? You do some silly thing such as what? Selling. When the company is doing better. So the second thing is if you do not compare share price to share price, what should you compare with? You should always compare share price with what? The intrinsic value. But in order for you to compare share price intrinsic value, you must calculate the what yourself? You must calculate the intrinsic value yourself. Now, yeah, so you must calculate intrinsic value because in order for you not to sell, you must place your trust and faith and belief into something. Yeah, some people Sunday go there to place your faith, trust into something, right? The Sunday one. Some people on a Friday one. Yeah, then the Buddhist one every day. Yeah, so you place your trust into something. Because you believe that when you place your trust in that thing, at night sleep peacefully. But in a world investing, is you place your trust in your analysis. That's the only thing that you worship, which is the analysis. Yeah. So Warren Buffett has reminded us, we are right because the analysis is right, not because other people are telling us whether we're right or wrong. Now let's come back to here again one more time. Now, if the share price is falling, even though when the company is doing well, so what does it mean? Most people, are they buying or selling? Yeah, most people are selling. Selling, Now, when I say most people are selling, who are these most? Yeah, the traders. So these most who are selling, let's say traders or whatever. Now, these most people, do you think these most people are making money? Most of the time, are they making money or losing money? Losing money. So you need to take note. If let's say most people are selling and these most people are losing money, and then you go and follow these most people, am I right to say that you're also following them in the losing money way? So the only way for us to make money is you do the opposite of these most people who are selling and then they're losing money. Which means that when they sell, what they do? Buy. But again, walao, say quite easy. When people sell, you buy. Walao, you try to buy yourself. Why? It requires courage. And then the courage and faith comes from the analysis. The data tell you that you're right. So if your blood pressure is healthy, it's healthy. People can argue, hey, you're unhealthy, hey, but I show you my blood pressure report. So if the world tells you that unhealthy, you still rely on the blood pressure report that you're healthy. So in other words, the world is saying that you're wrong, but you still want to insist that you're right. So what do you show them? You show them your own analysis of the SEGA and the intrinsic value that you're right. Yeah, this is the only thing you clean on. Yeah. Yep. Any other thing? This is very important. This is feedback by Ray. Because you were kena one. Then after that, you suddenly lose your faith. You lose your faith because the rest are all selling. And then you find yourself very silly because you're buying. Yeah. Any other things? For the past, I think, few months, I keep talking about the China Sunsin, right? Yeah. I mean, I assume that the financial report, they didn't fake the numbers. So the numbers is extraordinary. Now, even if this coming last quarter, even if the company has zero earnings, if the company has zero earnings, the 3/4 of the entire year's earnings still outshine their last year's last entire year by I think maybe 100% or something. I can't remember the numbers. Well, but the share price keep dropping. Drop until 0.9 something or whatever. But of course I bought some. Then recently I don't know what's happened. The share price just go up. Yeah, it's like that one. Yeah. So go I do nothing because I want to wait for you to drop and then buy something. Yeah. So now I go I do nothing. I won't sell, Yeah, not in the next 2 years. Yeah. Because I expect the company at least capital appreciate by 20%. When I look at the earnings growth. Yeah. Okay, any other things? Okay, if not, I'm going to ask Xiao Yu. Sorry, I take up this one because this one very important. Okay, so the next speaker before we go for our break is Xiao Yu. Xiao Yu, maybe you have 35 minutes. I'm not very sure how much time. Yeah. So, ladies and gentlemen, can you give Xiao Yu a huge round of applause? Thank you. So a cute little girl. Come on, and then share about investing. Wait, maybe you introduce yourself. Wait, I just make sure that. You missing? Okay, right. You introduce yourself first.
Hi, I'm Xiao Yu. The reason why I wanted to do the defensive value investing is because when I tried value investing, then I think I bought it at the undervalued price, then the price dropped. So you will see that if this is your first time buying the stock, you will feel very nervous because suddenly tonight you buy, the next day it drop. So you don't know whether you want to hold on or even though you have done your analysis, because this is part and parcel of the buying a stock. So
so how do you overcome this? Can you tell them how
it's after a while, because after learning the course, then I also read up on my own as well. So the only way that you have to build a portfolio. So to make it like you have to own at least like
a few stock.
So that you pretend as in like this is a pizza. If the whole thing is Hawaiian pizza, when the price drop by 50%, you'll find that half of the pizza is gone. So you'll get very nervous. But if you have like, okay, you divide the pizza into maybe
a few slices
or more, like half of people, maybe around 10. When a piece is gone, because it's so small, you don't feel the pinch. Maybe the price dropped by 20%, but the other stock are still moving up. So then it will help you to hold on to your patience, to hold on to that stock.
What's the maximum that we suggest during a class? How many percent one slice? Yeah, 10%. So something happened, 10%, the remaining 2% still cover.
Yeah, because psychological wise, it's easy to say hold on.
Yeah,
but when it happens in real life, sometimes your psycho override your logical.
Yeah.
Then you sell.
And then people will message me at night, ask me what to do.
Yeah. Then if one day you say, okay, never mind, you'll go up. But what if like 3 months is still down? So your psychology, you might want, some people or most people, they will sell off. Yeah. Then your friends who also invest, they also sell off.
Yeah, which is why having the community is important. It's like friends, no? It's like, hey, it's okay. Like, we want to assure you. Something like that. Yeah.
For my presentation, I think you want to take slide because I will be summarizing, but the slide have a lot of like a formula so that it'll be good for you to use it depending on which type of industry company you are investing. For the first part of my presentation, okay, this is what we summarize later because earlier on, for the value investing, normally you buy something that's undervalued. But what is defensive investing is because you build a portfolio. So if you bought a portfolio of undervalued stock, you will be doing defensive value investing. Because even one stock, like what we mentioned, one stock they fall in price, the whole portfolio as a whole, they will still grow if they are making money. So what we will be covering on will be how do we look for how do we build a defensive value undervalued stock. So the points I'll be covering will be profitable dividend, consistent growth. That means the stock wise we will choose Giant who have 10 years history of consistent growth and profitable dividend. And that means they have to earn high profit or consistent profit. That's why there will be a consistent growth. And also the finances, they do not have very high debt because I don't really like a company that borrow a lot of money. And also the valuation have to be low. That means like it's undervalued, PB less than 1, or PE is from 5 to at most 30, not more. And we will have to combine the value investing together with the defensiveness. Okay, so what do we mean? That means if you buy a dividend stock, it has to consistent give you dividend in every year for the past 10 years. You can have like maybe this quarter they don't give you dividend, but in a year itself they still provide you dividend. So if we have a stock itself 1 year they don't give dividend, I'll start to question whether this stock can I hold on or not. And then the 10 years dividend cover is greater than 1. That means you see the EPS divided by the dividend, it has to be more than 1. Whatever you pay out, you cannot be paying out a dividend more than what you earn. Example, a company, if it's not earning money, they won't be giving you end of year bonus. So if they are giving you end of year bonus, but they are still losing money, over the number of years, they might have no money to give you. Okay, so consistent dividend.
Maybe I pause it for short. There's some commotion regarding the last one. Maybe you want to talk about a 10-year dividend cover. It's something new to the class.
Okay, because I choose 10 years like Giant stock, they have 10 years consistent growth. So the earning
okay, in short, remember just now we talked about the earnings. Now, can you just tell me where does the earnings come from? What minus what equals to earnings? Revenue minus expenses equal earnings. So it's like salary, pay bills, you have savings. Now, remember companies can only distribute dividends and they have to distribute from the earnings. So in this case, they are saying that the earnings are divided by the dividend. Now, should it be a positive number or negative number? Earnings on top and then the dividend at the bottom. It should be a positive. Positive, that means what? That means they have more than enough dividend to be given up.
Yeah, and they have to more than 1. Because if their company earn 100%, they give you 100%, they have nothing left.
Yeah,
they need the return earning to grow their business.
Yeah.
Also.
Yeah. So in other words, they always at least something back for themselves. Okay.
Okay. So for a company itself, it's not every year is a good year for them. So the dividend sometimes it's not consistent. Like for Singtel wise, sometimes like the way you can see, like for Singtel in Singapore, the earning has been dropping, so the dividend they give is also dropping as well. But they still give out dividend. So I will watch out for like in certain quarter, if they don't get out dividend, is it because it's the profit that's dropping, or there's a lot of debt, or is it because it's cyclical? Because petroleum industry or petroleum company is cyclical in nature. So and also for like retail business is cyclical in nature. It doesn't do good during like bad times. So the dividend might also get affected. Like what we mentioned, maybe if the quarterly missing a dividend, that's fine. But in a year itself, they should they should still give you dividend. And because for this book that I read is mostly covering UK stock, so we are doing more of the UK company. So for this case meaty, you can see that it's more of a defensive stock itself because it touched on cleaning, security, and pest control. Like what you mentioned, like rolling. Okay. You will take, this is the, on the, let me see. Okay, on the right hand side is the dividend, on the left hand side is the earning per share. So that's how we mentioned that the earning over the dividend per share, it has to be more than 1. So for this case, it's 2.3. So if you are looking at dividend stock, perhaps you can use this formula to see whether it does have enough earning to pay the dividend. So that's why he mentioned about the payout, the ratio.
So payout ratio, in other words, the payout ratio must be less than 100%.
It cannot be like 90% is also very high.
Yeah.
Because when you look at dividend, you don't go in because it's high dividend. You have to look long term wise whether this dividend is sustainable. Yeah. Okay. Then company which have for dividend stock, you have to look for company that have consistent growth. Because for company that has irregular growth, it will affect your dividend as well. It also affect how much you can get back because you're looking for long term. If you go up and down, the growth is, you don't know how to balance it. Maybe when you balance it out, it's a straight line. But if it's consistent grow, then with the dividend you're getting, then you get more than what you have paid for. Okay, later we'll give you the calculation. So we only invest in a company that have growth quality of above 50%, and also for a company which the growth rate is above 2%. Okay, we will ask ourselves question, whether the company made any losses in the past 10 years, because I only look for company with a 10 years history. We also calculate how many times earning per share went up in the last 10 years, how many times the dividend has been given for the past 10 years. And what we do is, this is the calculation. You add up the number of times the revenue, earning, and dividend increase, and then subtract the number of losses and convert into a percentage. Okay. Now we move on. Okay. Example, you take this as example. When you go to read an annual report, there will be a revenue, earning, and dividend per share. So you get the past 10 years record. So we don't calculate the total of the revenue. We calculate how many times has it increased the revenue. So you know that there are growth. You also calculate how many times the earning per share has increased and how many times the dividend per share has increased. And whether this company had made any losses in any of one of the 10 years. So you can see from here, for the revenue, they increased by 8 times. The EPS increased 6 times out of the 10 years, and the other one is 8 times. So you add together minus 0 because there's no losses for the past 10 years. So in total, you got 22. 22 divided by 27 is because in total there are 9 years itself. So I times 3. So it's 22 over 27 times 100%. So the growth quality is above 81%, which is higher than what we mentioned earlier, 50%. This 9 times. This also 9 times. 9 times. So 9 times 3, 27. But they don't have, some of the times the earning per share didn't increase. So that's why the ratio is 22 over 27. Because it's not that every 10 years, everything has increased. Yeah, it's 9 years only. Yeah, if you count here, it's 9 years, 9 years, 9 years. So in total, 27. Okay, one problem for this, right? You have to see the start date and end date, like what we mentioned in the VIA funnel. If you choose something that's very low and the ending is very high, the growth is very great. Okay. And this is also good for company that's growing. If the company is not growing, this formula is I won't advise people to use this. Okay. For if you are touching on financial stock, bank stock, property stock, you will look at book value, which is PV. Because property, they have a lot of property, and then financial and insurance, they have a lot of money. So we look more into PV value. Okay, just now we use revenue, now we change to book value itself. Okay, for this wise, we have another type of calculation. Okay, we take the earliest, oldest 3 years, and we take the latest 3 years. So we add up the old revenue divided by 3, and then we add up the latest revenue divided by 3 as well. So with that, the new one over the old one, you minus 1, you get 128.8%. For EPS as well, we also do the same method of calculation. Then for dividend, we also do the same thing. So how in the end, how do we calculate the appropriate growth rate? We divide by the number of times plus this year itself, so it's divided by 7, so it's 21.4%. But if you want to be accurate, actually how much is the growth, you have to minus 1, so it's 14%. So if you are saying that it gives you for the whole period of time, it gives you 150% growth, but annually it's a 14% growth. So the compound annual growth is 14%. Okay. Whenever we invest in stock, normally you also look at your country and their country inflation. Because if you are saying Singapore is 3% and you are having a stock with 3% growth, it kind of like it balance out. So you normally choose something that's more than that.
Now, in case you find the formula very difficult, what do you do? You use our So the year calculator is for dummies. Yeah, so you put the first figure, last figure, the year, you come out the growth rate.
Yeah.
But of course, if you want to manually practice your math.
Okay, so the third one we will cover is profitability. You only invest in a company that has profit. And also for insurance company, there's another ratio that you can look at is the combined ratio. Combined ratio you don't need to calculate. You can just find from the annual report inside for the value itself. Okay, for a company itself, if you have only one company doing the business, the profit is very good. You can sell this like lemonade for 50 cents. But if you have more and more, they cut loss. They cut to 25% like the bubble tea. Okay, so when you have more and more, the profit is lesser. Like just now when Kaden mentioned about the gross margin, for the gross margin, you can see whether the industry is too competitive. When the industry is very competitive, they have to sell a lot to earn a lot of money. To earn the same profit, they might not be able to give you that much dividend as well. Okay, so in this scenario, you can either sell a cheaper lemonade or make your lemonade unique. And if, as a business person itself, if it's so competitive, you will choose to move on to other business with higher return. As usual for stock as well, if you find that you are not earning, example for person psychology wise, if you have two undervalued stock and another stock is earning profit for you in the long run and another one is not moving anything, some people they will prefer to move on to undervalued profitable stock. Okay, just now when we mentioned about the compound annual growth rate of the company, like what we mentioned, if the company annual growth is 14% and right now Singapore is 3%, it's logically to have this stock. That's compared that if the stock is having an annual growth rate of 2%, and then right now Singapore has 3%. So yeah, so it's lesser. So when you invest, you also have to look at whether they have any growth. Normally, companies that are very cyclical or they have very low profit, they will not be able to offer you dividend because if their profit is very difficult to accumulate, they don't have extra cash for you to give out as dividend. Okay, for this profitability, you can use the ROCE. This one, you might not need to calculate because you can get on Morningstar as well. They will give you return on capital that the company has invested. Example, if you are a company, you invest 500, you expect it maybe to give you back at least 10%, 20% or 30%. So if you have money, the company is pumping money, but they are not earning any return, then this is something that you can look at whether the company is making profit. Okay, example, in short, if you invest in the stock itself, over the amount that put in, you wanted to have some return. This same as go as for business itself. If you have put in the capital itself, you also wanted something in return. Okay, so for this wise, we have a calculation. Okay, we use let me see, the net profit. How do you get your net profit? We use our the fixed asset plus the current asset minus the liability. Then we divide by the capital employed, so we get 15.3%. So because this is manual calculation, but if you do normally you invest, you won't be doing so much calculation. You'll go to a website to get this information. So you'll see whether this company, for the amount they have put in, are they earning any return back? Okay. Yeah. Okay, just now we mentioned about financial company. So if you are looking at investing in banks, whether locally or annually, or even insurance company, you can look at combined ratio. Okay, combined ratio is the losses and expenses over the earned premium. So if they are how to say, if coming out with the policy itself, the company is the insurance company has more losses than earning the amount. Okay, example, insurance company sell insurance, you will pay a premium every month. Example, 200. If the amount they have to come up with their policy, the person salary and underwriting costs, the cost is more, then this policy is earning money. Example, okay. In short, is example, if the company you are paying 200 for the policy per month. Okay, maybe is around 2004 in a year itself. But they have to pay their staff 3,000. So this whole policy is not earning money. But certain insurance company did that before the global financial crisis, because that time the amount of premium they collected, they invest in stock, so that the amount of the profit they earn, they can pump in to cover this loss. So that's why right now they have a control that it's best that the combined ratio of an insurance company has to be less than 95%. This is something that you can take a look if you want to invest in insurance company like Great Eastern, or those like people are talking about Ping An. Those are other country stock itself. Yeah. Huh? Okay. Yeah, too many. Okay. This is the IIR is the return on investment. So right now what they have is 8.8%. And if you see from here, this is the premium that the whole company earn this premium collected for all those policy owner. Then after that, they have these are the losses and the adjustment expenses, because they need to pay those people working in the insurance company. So how much salary they have paid. So we come up with all this calculation. Okay. So there are two things that the formula you can look at. Okay, the loss ratio. How much loss do they come up with this policy, and the expenses divide by the premium earned, and also at the expenses ratio. The underwriter, they have to pay them salary. So these are under the underwriting expenses divided by the premium return. So this is a combined ratio, is the sum of loss ratio and the expenses ratio. A greater than 1 ratio means that it's underwriting loss. Okay, so you don't need to know how to make this calculation, but you can take a look at the company combined ratio, whether are they making a loss selling all this policy? This very specific. Bank later on we will look at another ratio. So perhaps you don't need to learn this kind of formula. You just look out for combined ratio of the insurance company, which is less than 95%. And then this one you can see you can look at what are defensive stock I have arranged here. These are all the defensive stock, followed by the cyclical stock as well. Yeah, so you can have a look. Some people they are more defensive value investor in nature, so they are more into defensive stock. Okay, for if you wanted to invest in cyclical company, you have to make sure that the debt ratio is less than 4. Then for defensive, we have, because it's defensive in nature, so maybe less than 5. And also for bank, this is the one that we look at, the common equity tier 1 ratio. This is, you also don't need to calculate, you just have a look at the annual report. For insurance company, the premium burst ratio has to be less than 2. This is also can be found in the annual report as well. Yeah, later we will, yeah. Okay, so for this wise, for the debt ratio, just now we mentioned, you have to calculate the total current liability and the short-term liability. So what we have is 20,308. Then we divide by the number of profit. So debt ratio is loan over your profit. So if you can see from here, for this mining company, there's only debt ratio 2. Okay, so the let me see. Okay, so it meet the criteria. If you go earlier on, the debt ratio is less than 4. So it's between 2. So this is still defensive in nature for mining company. Because for mining company, it's a cyclical company.
By the way, in case you find too cheap, right? That means it's outside your what?
Yeah.
So don't feel bad.
Yes. Because I don't use all formula, but I do take a look at some of the formula that I look.
I saw some cheap stuff, I also like. So don't feel bad. Don't feel
Yeah.
T-Ray is coming. Don't
Okay.
by the way, in order for Xiaoyu to share this, it's really very difficult.
Yeah, because I have to internalize actually what they are talking about.
Such cheap things.
No. Why I wanted to do, because okay lah, when you buy a stock, then you lose money. You start to wondering whether your strategy works. That is how I feel. So I wanted to build a portfolio and what kind of industry I should focus on. What are the key ratio I can look at? So, like example, when you form a portfolio, you don't do all energy stock, then you put all energy stock. You don't buy all property stock, then you all property. So when fall, everything fall. So this one is to let you see that to stabilize your portfolio, perhaps you can look for more defensive stock. So those defensive stock can help you with those like fast growth stock that you pack into your portfolio. Yeah, this is what you maybe later on along the years, maybe you will take a look. So for supermarket, I like consumer stable stock because you go in every day, you also buy. During crisis, you also will buy. You buy, it's a matter of whether you choose Sheng Siong over Cold Storage. Yeah. So for defensive stock itself, the debt ratio, we should have higher ratio because their income are more stable. Okay. So for this case, for the debt ratio, you find is 5.4, which is above our debt ratio stated earlier. So you might find that this supermarket doesn't mean that it's a supermarket, it doesn't take debt. So when you find that this supermarket has borrowed a lot of money, perhaps you can change to find another supermarket stock. Because there are so many supermarket stock, you don't need to stick to one, though they are defensive in nature. Okay, the CET1 ratio is another thing. Look at when you invest in bank itself. Okay, you don't need to make the calculation. This is just for like for the book wise, they will put the calculation inside. But normally you have to take a look at the CET1 ratio. Why do we need to look at CET1 ratio? You will know that banks have money because you deposit your money in the saving account. They will also have their return earnings. but they also have loans. So not all asset that the bank own are no risk. If they take a lot of my mortgage loan and they lend a lot of money to like maybe other company loan, so during crisis itself, you also have to they are able to sustain. So we use Standard Chartered. So the common equity tier 1, you also don't have to be calculated. You just take out from the annual report. Okay, from here you can see the minimum is 12%. So we wanted something that the minimum is 12% because we wanted something that out of the 100%, the 12% are the real asset. Anything you liquidate, the 12% can be paid for the loan itself. So if the bank itself, they have 1% only. So 99% they are all like loans. So in any cases, if the company that they lend their money to close down, if 99% are all company loans, they won't be able, your saving that you put in the bank itself may not be recovered. Okay, this is premium to surplus ratio. For every premium you for the insurance to come out with the you can choose this premium to surplus ratio, or you can choose just now the combined ratio to look at the insurance company, depending on which one do you prefer to look at. For the when the insurance company write the premium of like example 200 that you pay every month itself, they also have a regulation that control depending on how much surplus you have in your company. If your surplus is very little, you cannot write so many policy. Okay, sure. Okay, so this is something that let me see. Okay, how do we calculate the average premium to surplus ratio, which like what I mentioned is we don't need to calculate because you can find in the annual report as well. So we use the example for the first one, you take 3895 minus the 12 total equity minus the intangible asset, you get the surplus. The surplus, you use the premium divided by your surplus. So you get 2.8. So what we have here is 3.3. So minimum, the preferred maximum is 2% for the ratio that what we have. So you can look at that as a, so every time if you look at an insurance company, you can look at whether you have maximum 2. You don't need to calculate the whole thing. You just the key checklist. Okay, so low valuation, just now we mentioned, for PE, we use 10 years, a stock with 10 years history, a giant stock. It's not like 10 years, they are low earning, those like 10 years with 10 years consistent growth. Because best is up. If this is not moving up, then it's something like maybe a straight line. But best we got stock that have consistent growth. Normally, I'll look at PE 5 to 30. What is PE? In short, that number of years you put back, you buy a stock. If you see 30, maybe you need 30 years to get back the same amount of capital. So some people, they will look at 5 to 30. If you have like, what is that stock? 10 cent or growth stock, technology stock, they might have very high, 100. So if the technology stock only grow for 10 years, after that it doesn't grow, then there will be a risk for you as well. Okay, we also invest if the current price, 10 years of dividend, is below 60. So for all this stock itself, what I wanted to say is actually when you buy a stock, you have to know the company well. You don't buy a stock because other people are saying good and then you buy. And for this defensive value investing, you have to look for 10 years unbroken dividend record. So every year it has to give. But it doesn't mean that every quarter they have to give you the dividend. They can miss one quarter. But if you have 1 year they didn't give dividend, actually you should go back and take a look because you are doing long-term investing. So if you hold on to the stock, you just maybe since you already done the research for the company, you might want to go in, just take a look. Why? Why is it that they don't give dividend? Okay, for this aerospace and defense sector, just now aerospace I put inside is because there are certain airline that move into more of defense, not those commercial, but more of defense airline. Okay, so they have the growth rate of 6.4% and 81%. So this is the earning per share and also the dividend per share. What we do, we add up all the 10 years of the EPS, which you can also use at the formula that we have, the VIA funnel. So from here, you add up all the 10 years, you get a PE 10, 15.6, which is within our criteria. Then you look at the dividend, you add up, you divide by 10 years, it's 16.1. So it's also fulfill our criteria. So then I will decide to invest in stock itself after I did a research. Then this is ARM Holding is a technology stock itself. They develop licensed technology like smartphone and tablet. So if you look at here, the PE 10 technology stock, normally the PE is very high. Okay, because people invest in their growth. They think that they can grow further, so the PE is very high. And the dividend, if you can see, is price over dividend is 270.3, which is very high for me. So if you are going into, it depends on yourself. If you are very growth investing, people may may want to invest. But if you are looking at value investing, people might not want to invest. So when you have a portfolio, you might want to first put under value investing stock first, under value stock. Then from there you can have another portion for growth investing. But your growth investing cannot be like more than your value investing. Oh, okay. Okay. So what we do, yeah, this one is easier. Though there's for level 6, to make it easier because there's a lot of calculation involved. You have to use you look at growth rate, growth quality, and also the value factor to make it a defensive in nature. So you have to ask yourself, when you look at, you have your own checklist. It depends on what kind of strategy you want to use. You have to have your own checklist. So we look at here. Okay, example, if you look at here, you have example, you hold on to 1, 2, 3, 4, 6 stock. Okay, there's a lot of number here. You tabulate, you put inside. But what will you do is you can rank it. Example for share price. Who has share price? Don't look. We look at the growth rate. Which have the better growth rate? We give them 1. Then by 2. So it make it easier for you to compare because you may not be holding a lot of stock. Maybe you hold 10 stock. But if you only have 1 stock, you cannot do this kind of ranking. So from here, you add up. They have a defense value rank. So if you see for the Petrofac, you have a 10. So from here you rank, you can see that actually Petrofac has the most defensive value rank. Because you look at it, you will get very confused. So within your 10 stock, you rank them. 23 is because some people they have very big capital. So you can have a minimum 10 stock. Or some people they really have a lot of capital, they might want to look at 30 stock. Okay, so this is a summary of what I mentioned earlier. You rank it instead of putting all the value. Oh, actually all this thing is a ranking. So we here. So for those the lowest that you have, they are more defensive in nature. Because we add up the I add up. Yes. Yeah. Okay. That one you don't need because it's the same thing. So example, if you look at Hughes and Smith, the target price right now is under 16. So if you have a choice, you'll go for 12 first instead of 16. It's because it's more defensive in nature. But what if there's one day Hughes and Smith holding they drop in price, but the fundamental, like what we mentioned, the earnings are growing, the dividend are growing. So this thing will adjust because you plug in again. So when we have a, how they say, when you have a portfolio of stock, maybe now you don't want to invest in this stock because it sticks in. So when the price fall, you might want to take a look again. Oh no, that's the formula only. Yeah. Okay, let me see. Okay. Yeah, like what we mentioned, if one of the stock, all those stock that's in your list, by ranking, they're all defensive in nature. So when they fall by 50%, you find that everything fundamentally is unchanged. We will take a look at going into the stock itself. So later on for the part 2, I will cover what is value trap itself for the next presentation. So because another thing that you have to take a look is for the undervalued stock, you have to know that whether it's a value trap. Though it's cheap, but is there value in the company? Then we also will be looking more whether there's moat as well. That will be covering for the part 2.
Okay, Ranger, can we give Xiao Yu a round of applause? Yeah, because the slides is really quite technical. So I think during the break, if you have any question, please feel free to ask her. It's really a lot of calculation. So right now you appreciate that it's always good to have some tools. Yeah, some tools, some formula, just copy paste, understand, copy paste, copy paste. So let the yeah, very good. And some of these things covered predominantly is not covered. Like ratios. Yeah, it's not. It's really new stuff. Yeah, CET, all the stuff. You can check with Xiao Yu later. Hey, by the way, it's not easy. Xiao Yu also has never invested before, so she has to like brainwash herself to go and do this. This book is difficult. Hey, for that, can we give Xiao Yu a round of applause? Thank you. Yeah, I just let Xiao Yu have a rest. Now I'm just going to wrap everything up. If all this set of not really, we are not going to upload the slides, but remember the video is inside. You can always do screenshot. You can always download the video and so on. So I'm just going to share one last thing very, very quickly. It only takes 5 minutes of our time, because we overshot. And then after that, we're going to invite another speaker to come and speak. Okay, so I'm going to do this very quickly. Now, let me just. Yeah. So in future, we will keep our presentation as short as possible and less technical. Okay, let me just put up my slides. Yeah. Now, I think recently there is a midterm election in the US. Now, I'm not a politician, so I'm not very sure how this one is going to work out. Yeah. But I know there's something that I cannot control. Even though it's something that I look forward to. Now, I just want to share with you, there are some patterns based on the past economic crisis, and if there is, how can we take advantage? Yeah. So before we go into detail, remember during our training, we talked about our portfolio, which is what Xiao Yu was emphasizing. So predominantly, the entire slice, we cut into 3 slices. So can you tell me the first slice as a revision? What do you think is the first slice? Yes, cash. The cash predominantly is like a defender in a soccer team. It's not to make money. Okay, it's a defender. So in case a crisis comes, we can take advantage of it. So during the training, we said the cash predominantly serve 2 purposes. What are the 2 purposes? One is for, correct, and new opportunities. Then the midfielder is the ETF. Of course, ETF, we talk about STI ETF, where you can use the POSB autopilot. We also talk about the dollar DEX. Talk about dollar, you can use dollar DEX. Yeah. So the last one is what? Last one, the RSP. RSP, unfortunately, we do not. I don't see anyone coming on the platform, so then you to manually do it. But if you find manually do it a bit troublesome, just stick to the STI and the dollar DEX. Yeah. Hey, by the way, just curious, how many of you has already applied to have a dollar DEX account and all that? May I have chance? You see? Okay, one more time. Dollar DEX account. I see talk only. You are at 10 class, don't want to do. Now, the opening account only take you 10-15 minutes of time. Okay, the STI ETF, the POSB one, may I have chance? Oh, this one slightly more. Yeah. Hey, by the way, the dollar I cannot press for you, that one. Oh, I really give you the screenshot, all that.
We would like to know, we know how, now you teach us how to put in money, but how do we
Hey, that one, can you ask the platform owner? Yeah, because I'm a long-term investor, I never withdrew money out. So it's a good question. It's a question that I have no answer. Yeah, because I don't intend to withdraw. Wow, it's like 20 years later, I tell you. but I don't know lah. So you ask the platform owner, please. Okay, so this one. Any other things regarding the ETF? Okay, so the last one we talk about the stocks, yeah, which is predominantly a striker. Now, so right now I just want to focus on this. Now, using the dollar dex or whatever, remember it's dollar cost averaging. That means you invest a fixed amount over a regular time period. Yeah, time period. So if let's say you put $500 every month, 500, it peaks 500, and then suddenly there's a crisis, you also 500 down. So 500 up, 500 down, 500 up, 500 down. So fixed amount over a regular time period. So if you draw one line that plot cut across all this, eventually your gain will always be positive. Yeah, it will always be uptrend now for S&P 500. I'm not very sure about the rest. Yep. Now let me share with you. The next 1 minute, I just want to share with you why crisis is an opportunity if crisis happens. Okay, ready? Now I can only base on the past two crises because much earlier the peak and the drop is actually not a lot. Okay, so here can you see here in year 2000 the share price peak, right? And then after that something happened and then the thing dropped. Now give a guess what happened. What was the bad thing that happened between this year 2000, 2001, 2002? Yeah, dot-com bubble. That's when I lost that 50K. Yep. So you see the S&P 500 index peaks at this number 1527.46 point. They usually use the point. Yep. On the 24th of March year 2000. So that was the peak. And then after that the crisis took place. Yep. So you see here it drops to here. Aga it drops by how many percent? Yeah, Aga dropped by half. So here I put 47.6%, but it's around 50%. 50%. And then you realize that it takes some years to recover. Okay. So don't say you are so smart that you buy at the bottom. If you buy somewhere around the bottom through dollar cost averaging, or while the dollar dex is doing work for you, then suddenly you realize that got $1,000 below your bed. Then you take it, then you don't know what to do with it. Then you throw it there. Now, so while the dollar cost averaging and dollar dex is doing the work or whatever, then you got extra $1,000. You just trade around here, not at the bottom. I don't say because we cannot determine. Then do you realize that this is the peak? It drops and then here goes to peak. Now, from here to here, how many percent?
100.
Yeah, it's close to 100. So don't say 100 lah. Maybe we make 50%. We make half of this one. We also killed you, right? Because you cannot buy the lowest and sell the highest. You buy the lower and sell the higher. Yeah. So this is one example why during the bottom when people sell or we buy. Yeah. So this one, So this is the crisis that we talk about, the dot-com bubble, the 9th September 11. So let's talk about the most recent one, which is the Lehman Brothers. Now, Lehman Brothers, the S&P 500 index peaks at 1561.8 point, 12 August 2007. And then after that, it falls. Yeah. You see, even the crisis takes some time. Here's almost like 1.5 years. It doesn't like one day go straight down. Yeah. This whole thing 1.5 years. Yeah, 1.5 years. There got someone. Yeah. But so it drops by same thing about 50%. But today, surprisingly, after Donald Trump became president, the S&P 500 go up. I expect it to collapse, but it didn't collapse. Yeah, so the world is really crazy. You cannot guess stock price. Now, today, you know what is it? You see, 683, right? This 2007, Of course, here to here take how many years? 9 years, But 9 years, if you make 300%, do you want? And you do nothing, what? You see, dollar cost averaging up, right? Dollar cost averaging. So there are a few points I want to make. Now, first point today is better go and open a dollar dex account. Well, only 3, 4 hand. First one. Then the second one, PSB also quite easy one. It's online only. Yeah, I really give you a step. Well, I'll give you a step. Also don't want to click. Wow, I give up already like that. Okay. Now, so this one intention is you really have to take action, open an account because you already been taught. If you nobody teach you, then what? Then maybe you got excuse. But now no excuse. So this one. Now, the another point is next 1 minute, I just want to introduce a scheme again. Now, for those people who have attended our training, you have seen the slides. So you just be patient with me. Now, how many of you in this room, you already joined our partners program? Can I just have a show? Partners program? Anybody? Yeah, it's only a few. Yeah, it's only a few. But I just want to share with you again. Now, ultimately, in order for us to take advantage of any crisis, there are a few things that need to take place. Number one, it requires knowledge. I tell you how to open dollar dex. Then the next one is require cash. So there must be some spare cash lying around. Of course, even the recovery of the crisis takes some time. Now this one is 9 years. But 9 years you do nothing. Do nothing and then 300%. Yeah. So it requires knowledge, cash, and then time. And of course you have to do something. Now there's so much I can do. The clicking one you really have to do yourself. Yep. So in the next 1 minute, I'm just going to talk about how to raise cash. If cash is an issue, but if cash is not an issue, then you can switch off for a short while. Okay. Now, So the next one is talk about cash. Now, during our most recent training, I'll share with you screenshots of the check that we issue out. For example, this is some of the checks that we issue out in 2016, but the most recent one that we issue out is this one in 2018. Yeah. So in 2018, we issued a huge amount of check. I think from the first 2 quarters, which is the first half of this year, we issued checks about 12,000 plus. And all these checks go to who? All these checks go to our graduates who refer friends to join our class. Now, I just want to let you know that when you ask your friends to attend our class, you're actually helping them. Because I'm very sure tomorrow you go back to office. If you sit down in one space, you go and take one string and then 2 meters and then draw one circle. I'm very sure this 2 meter parameter, I think most people, 90% of people will never invest. Yeah. Yeah. So my intention of sharing with you this is sometimes during a normal conversation or whatever, if you come across friends who say, oh, no money or whatever, and they don't know how to invest, you can just share with them. Yeah, this is not an MLM, it's not a multi-level marketing or whatever. It's just over a casual conversation. You say, hey, recently I learned something about investing. And if let's say they're interested, you can always ask them to come for a class. I mean, if they want to come, they come. If they don't want to come, then it's okay. You don't have to force them. Yeah. But the key thing is, in the moment you start a dollar DEX, your STI, you buy one stock, you have some experience, you can share with your friends. Now, like for example, in this case, I think there's an error here. It's 1,244. I put my comma should be here. So these are some of the checks. These are some of the checks, not $12, 1,244. So these are the checks that issue out. And I just want to let you know that these are the referral scheme if you decided to join us. So for example, if any of your friends join us, we are going to send you a check. So the first check is $500, then the second check is $500. And then subsequently, the check that we give out will be in multiples on 800 until the calendar ends. Then the next year, we start the cycle again. So in your head, you just need to remember 500 and then 800 all the way until the end of the year. And then this whole cycle, repeat this again. So in order for us to help you so that you can share with your friends, if you decided to, so we are running a one-day training, just a day, on the 5th of January. Now, if you want, you can take a photo of this. Yep, it's on the 5th of January, or you can key in your diary or whatever. So 5th of January is on a Saturday. It's from 9 a.m. to 5:30 p.m. Now, just take note that this training is got nothing to do with value investing. Yeah, it's only got to do with sharing through Facebook. Anyway, Facebook is free. Yeah, you're going to post something anyway. Must as well post something that's helpful. Yeah. So this entire training, we run a couple of modules to help you share what you know. So for example, the first module, we talk about personal branding through Facebook profile. So if you want to learn something beyond value investing, this is really useful. So personal branding through Facebook profile. Now, how many of you has added me as a friend? If you don't add, it's okay. I won't like mark you. How many of you by chance you added me as a friend and approve it? May I have chance? Yeah. So do you realize that I'm very active on Facebook? Now I'm active on Facebook not because like I KK one active. It's I naturally quite lonely. So I go and so I post or what I do. Just now I just do a live video. And sometimes it's through these people go and see my things then ask me what I do. Yeah, it's quite strange one. So if I want to post, I just post what I do. Yeah. Yeah. So somehow people just got to know me through Facebook. And then just now the Jun Ting. Yeah, he say he going Facebook ad, right? You can click, you see like that also can. Now, so on this day, 5th of January, we run one module. It's predominantly an online marketing module. Very simple, no technical stuff. You just need to have a Facebook account. So we talk about online marketing strategy, secrets of Facebook marketing you never knew, hands-on marketing, and so on. Then module 2, we talk about how we can generate leads and income with zero cost. We do not expect you to pay any advertising fee or whatever. With a done-for-you blog. Now, this afternoon, we just met up with one of our vendors who's helping us to revamp our website. So eventually, I think by end of this year or 1st of January, we have a new blog launch. It's going to be one of the nicest website ever. Yeah. Yeah, it's really nice. A lot of things we put it in. Hey, by the way, our blog site, you just go to valueinvestingacademy.com. We write very, very useful information. And we pay our graduates to write those information. Sometimes it's case study. Sometimes it's very basic. So it's like a book that's being put on the blog and it's free. You don't have to pay for anything. Now, so how can you share information, which is predominantly content-based, no sales-based? How can you share with your friends? Very easy. Now, the moment you become a graduate, we give you a unique link. So every article has a unique link. So what you need to do is you just need to share this link anywhere. It can be on LinkedIn, on Twitter, on Facebook, or whatever. So in case if they happen to read it and then they attend our class and then eventually you join, we just pass you the money. So your role is just to share and then the rest we do the work. The machine do the work, the human at the back end do the work. Yeah. Okay. So this is how our website look like. Yeah, which is we are undergoing some revamp. Yeah. So you just need to, like I say, share the link. Okay. So first one is like how I share things on Facebook. The second one is we use the unique link in our blog site. You can just share, and the moment they click, if they join us, you will know. And then the next one, how to use your Facebook account as a ninja referral machine. In short, we share with you how to set up a fan page, not a personal account, but a fan page, and then make use of some of the features to share information. Now, this is one of our top affiliate or referrer. His name is called Chris Susanto. Yep. And same thing, he's generate quite a bit of income. And we need to take note for his context, he's a school dropout. Yeah, he intentionally want to drop out. He can't finish his study, but he has chosen to drop out. So on average, every single year, the referral fee that he has is close to 10K. Yeah, and he has with us for, I think, past maybe 4 years, 5 years. So just the referral fee alone will be close to 30, 40K, which is 10 times the fee that he put in. Yeah. And he just share. And he share, he feel confident of sharing because it has really helped him. So after that, subsequently, he learned some technical skills. He started off with own blog. Yeah. So these are the referral scheme. Now, I just want to let you know that that there is an investment that's required if you attend our training. Yeah. So the investment is 488, but there's a good news. The good news is this amount is refundable. Now, so for those people, if you decide to join us, it's 244. And when I say 244 is refundable, what does it mean? It simply means that throughout your entire lifetime, if any of your friends successfully join us and then finish the training, now what we do is we'll return you this 244. So under our balance sheet, we part under our liability. So if you join, we return it back to you. So not only we return this amount back to you, the training is free. It's free, and then the referral you keep. So can you just tell me what is your risk? If let's say you participate, what's your risk? How many percent? Yeah, it's 0%. It's 0 because we're going to pass it to you anyway. Yeah. So are there any yearly membership fee? These are FAQ. So just help me to answer this. Do you think are there any yearly membership fee? Yes or no? No, I don't practice this. Yeah. Now the same one, any other software, anything I need to pay during training? The answer is what? Yes or no? No. Yeah, I also don't do this. How long does my membership last? Forever. Yeah, lifetime. Imagine gathering is lifetime. Actually, I regretted making this promise. So what sort of IT skills do you need? Yeah, you need to have a Facebook account. You can type, you can speak English, and then that's it. Yep. So these are some of our events. Now, we really highly encourage you. Yep. So you can just treat it like your temporary park 244 with us, and then one day there's one referral, we just return back to you. Yep. Okay, good. Now, so if let's say you decided to join us, after that, when you can just go and talk to Catherine or Irene or any of our staff at the back. Yeah, but remember when I say today 244, we really mean it, because we know that somebody will say go back and think, and then tomorrow say hey, I want to join. Now tomorrow if you call Catherine, now we already gain enlightenment already. Now so tomorrow if you call Catherine and they say, hey Kaden, yesterday I didn't join, but I want to join today. I say can do 488. Yeah, so we already gain enlightenment. No matter what you say, you'll be 488. Yeah, so only tonight, including those at home. Okay, good. So right now, ladies and gentlemen, we're going to now, after when we come back, Jia Yang with the presenter, so Jia Yang, your time become very short. Yeah, time becomes short. So I think maybe in 25 minutes, you have to finish. Jia Yang, where are you? Yeah, you do it very short. I don't know how many slides you have. Okay, good. So the break, we're going to put 15, maybe about 12 minutes. So we do it as quick as you can. Okay, good. Good, Okay, so ladies and gentlemen, what we're going to do, okay, so ladies and gentlemen, every single one of you to just stand out, right? Stack out your hands, right? Stack out your hands. Hey, how come no music? Okay. Stack out your hands. Okay, so ladies and gentlemen, are you ready to be financially free? On 3.